1929 to 1930, 80% crash in the market. 2008, 57% crash in the market. 1938, 57% crash in the market. What caused these recessions? And are the economic factors that did similar to the economic factors that are happening in the market today? Inflation, interest rates, unemployment, GDP, corporate earnings. If we can understand what caused the previous recession, we can be ready for the next one. In this video, I will be dissecting the past recessions and what caused them, and looking at how that relates to the economy today.
Is it Brian? Yes.
Hi, I'm Giannino. I teach you how to make money, grow money, and invest money, so please like this video and subscribe to the channel. I would greatly appreciate it. Why am I going into depth on recessions all the time? Why should you care? Isn't it annoying when someone screams recession all the time? Of course it's annoying, but there's plenty of evidence that there's a recession around the corner, and all I'm trying to do is prepare you for it. There are certain economic factors that do cause recessions, and we're going to be looking at the past recessions and seeing how those economic indicators looked. If there's any correlation between inflation and recession or interest rate and recession, then we can compare it to the data today to see if we're going to have a recession in the next couple of years. But most importantly, if we don't see a recession, this video is really going to help you understand a weak market. Because if you know when a market is weak, you can shift money to different assets, get out of riskier assets, and most importantly, build some cash on your hand so you can invest in all these discounted stocks and index funds. That's all I want to do in this video, is see what economic factors lead to a weak market so we can identify those and see if we're in a weak market today. Because like I said, if you understand if the market is weak, you can capitalize it, and most importantly, buy these assets that are going to be discounted soon. And the economic factors we will be looking at today, which are the most important ones, are interest rates, inflation, unemployment, and most importantly, the PE ratio. Just a general overview, the PE ratio tells you how expensive or cheap the stock market is. When the stock market is super expensive, that is usually an indication that the market's going to pull back to some reasonable levels. So with this indicator, if the PE ratio is above 20, I'm going to mark that as a possible reason that could have led to that recession. And next, I'm going to look at inflation. If inflation is above 4%, I'm going to mark that as a possible reason that led to the recession. The other economic factor is interest rates. If those are above 5 or 7%, but more importantly, if they were raised too aggressively, that is another possible reason we could have been led into a recession. So if that criteria is met, I will be putting a green check mark. And lastly, we have unemployment. If we have low unemployment numbers around 3 to 5%, more importantly, if we're hovering around those levels for too long, that can also lead to a recession. So if that happens, I will mark a check mark. And as I go through every recession, we will see which one had the most checks marked. And more importantly, at the end of the video, we will know which economic factors most likely lead to recession. The first recession we're going over is 2007 to 2009. You may have lived during this one and you may have experienced it. During this time, unemployment was 4.5%. Check mark. Interest rates were raised from 1 to 6% in 10 years. Check mark. Inflation was 2 to 3%. That's actually good. No check mark. And lastly, the PE ratio is 27. Bad. That is extremely high, and that is a sign we're in an overvalued market that needs to pull back. Just by looking at the 4 most important economic factors, we can see that 3 out of the 4 were green lights for a recession. We had the perfect storm brewing with low unemployment numbers, an overvalued market, interest rates that were raised too quickly, and we did get an inflation spike in 2006, which was Katrina, which most likely correlated to rising interest rates. Although this was the perfect storm brewing, there was some actual corruption going on with the banks and the overall economy. Most of you know this story. This was the housing crash of 2008. This is where banks basically lent money to people that weren't able to pay it back. So this made the housing market boom. Everyone wanted to make money in the housing market. Everyone saw it as an opportunity, but those who could not tried to do it in the stock market. They tried to create investments from these bad loans You may have heard of these terms: CDOs, MBSs, mortgage-backed securities. These are all fancy terms and saying how bad loans were packaged together and tried to make it look like they were good investments. So long story short, people were investing in funds that they thought were related to the housing market because they wanted to be a part of those tremendous gains, but those were connected to terrible loans offered from the banks. So although the housing market crashed, it wouldn't have affected the stock market if these funds weren't made in the stock market. All in all, this corruption and greed led to the recession in 2008, but it probably wouldn't have been as bad if there wasn't three huge economic factors making the economy overall weak. Moving on to the next recession, this is the 2000 internet bubble. During this time, we had inflation around 3%, which is neutral. We also had interest rates raised from 4 to 6% in 6 months. Not too bad, that's also neutral. Unfortunately, unemployment was 4%, super low, very bad, check mark. And we also had a PE ratio of 45, which is double what it was during the crash of 2008. Extremely bad, check mark that. So just overall, we had two economic factors that could have led to recession and two that were kind of neutral, not helping or really hurting the market. The main reason the stock market crashed is because there was a huge bubble developing within it. This was the internet bubble. This was a time where companies would just put .com on their stock name or just even make a website and their stock would go up 100, maybe even 1,000%. This was unreal gains, similar to Bitcoin, similar to pot stocks. This was a bubble. The best way to understand that this was a bubble was because the PE ratio of the overall market was the highest in history. That should be a great sign that you should not be holding investments. They were too overvalued, too expensive. So the main reason this recession happened is because greedy pigs were trying to chase returns in the stock market. They were shorting the market and they were buying on news, all boosting valuations to unreal places. And the funny thing about this is most recessions are impossible to see coming, but this one was the most obvious one in my opinion. Let's move on to the next recession, 1991. During this time, inflation was 7%. Bad. Interest rates were increased from 6 to 10%. Bad. The PE ratio was 17, neutral, and unemployment was 5.2%, also bad. And all summed up, we had 3 negative factors and 1 neutral factor. So this was another perfect storm for a recession brewing. And the main cause for this recession was inflation because we had rising gas prices during this time. If you think about it, if the price for you filling up your car at the gas station doubles or triples, that money you cannot use to buy groceries. You can't use that money anywhere else. Inflation basically decreases your buying power because gas went up, you had to spend more at the gas station, decreasing the money you could spend everywhere else. That money you couldn't spend everywhere else is not fueling the economy. So I think you can understand that rising inflation leads to an overall weak economy. Most importantly, when inflation goes above 3 or 4%, the Federal Reserve has to raise interest rates to drop inflation. That is the only way we can get rid of inflation. But here's the thing, recessions are caused by increased interest rates because that does also slow down the economy. So it's a double-edged sword here. We have inflation causing recessions and we have to have interest rates rising, which also causes recessions. So it's really hard to say what caused what, but the main factor here, the main cause for this recession was the inflation that jumped up. This just goes to show you that inflation is a huge economic factor for causing recessions, and it's one we have to pay close attention to. Let's move on to the next recession, 1980 to 1982. During this time, inflation was 14%, which is double what we had in 1991. Interest rates were sky high at 22%. Basically, the Fed was doing everything in its power to lower that inflation. Unemployment was 10%, which is neutral, and the stock market PE was 5%, which is actually good. But why would the PE ratio be high? Because normally you can make 7 to 8% in the stock market, but when interest rates are 20%, that's 3 times the return you could possibly get in the stock market. So why would people put money in the stock market? Why would they risk something when they can get a guaranteed 20% payout from a bond from the government? That's why the stock market was so cheap, was because no one wanted to put money in. Bonds were just such a better investment at that time. So yet again, inflation was the main cause for this recession, and the rising interest rates to combat that also had the economy super weak at this time. And here we are, the most important recession out of them all, the recession 2020. I know it hasn't happened yet, but this is why we could see a recession, because we have interest rates at 2.3%. Because we had interest rates raised too aggressively from 1 to 3%. Those are also extremely low, but it was raised quickly. We also have inflation at 2.4%, which is actually good for the economy. But here's the killer. We have unemployment at a 40-year low. This is at 3.6%, and it has been down here for a long time. Here's why we can see a 2020 recession, because that inflation number of 2.4% could jump up to 7 or 10% if this trade war happens, because if we put tariffs on Chinese imports, those goods coming in are going to cost more. So obviously that's going to increase the cost, which also is going to increase inflation. We know from the past recessions, 2 out of 4 of them that I listed were caused by inflation. Inflation is a huge killer for recessions. Not only that, but 2 out of the 4 I listed earlier were also caused by a high PE ratio. The market was overall just very expensive. So right now, the PE ratio of this market is at 27, which is the same PE ratio of the market in 2008. So right now the market is unbelievably expensive, and if we see a rise in inflation, we're going to have interest rates go up, which is going to sink the economy. So unfortunately, everything looks good now, but we are on the brink of a recession if just a couple factors change slightly. I want to prepare you for how to profit from the next recession and make loads from it. So check out that video to the right of me where I go in depth. The recession is coming and there's nothing you can do about it. So why wouldn't you want to be ready for the next recession? Instead of worrying, you should be excited, because this is the only time in history a person with a small amount of money can turn it into a large amount of money.